options trading on chain, acquiring the elements of diversity and long linearity of traditional finance options product to suit a fast evolving DeFi. So Zomma protocol is feature complete, competitive to converge and to welcome all TradFi and DeFi traders and users. So these are some of the topics that I'll be covering today, sharing on why DeFi options and why options, and what are some of our infrastructure, and how do we get the price mechanism for Zomma, as well as some of the innovations that we build, such as liquidity pools as makers and pool as the products, and also we offer liquidity addition and removal at any time. How do we manage to get that and our core team? Okay, these are the reason why that we want to do DeFi options. So I know people are really familiar with perpetuals and futures. So as you can see, the trading of options, the trend is getting more and more significant. And even like up to this year, February 20th, the trading of options volume is catching up to the futures trading. So that's why we think options is a really useful tool in terms of hedging and in terms of safeguarding your assets as an insurance. And these are some of the problems that we find out and we realized during the centralized exchange is that we took these screenshots from Deribit, like the most volume trading, derivative trading, centralized exchange. So options products, there are two, which are the call and puts, and we try to offer as much spread as possible, right? So there will be different strike prices. As you can see from here, there are about 13 strike prices with 11 expiration dates to cover a wide range of the trading choices. So this will add up to about 300 SKUs. So each of them is an individual market by itself. So what does that mean is that we think at a product which is at the early development stage, where the liquidity can be quite insignificant in a sense, that with using the order book matching style can be a little bit inefficient. So that's why what we are building right now is we aim to be the DeFi adventure that focuses on paving the financial infrastructure. Just align with what Vitalik just mentioned, that we want to build something that's like Uniswap, where we allow others to build on top of us, and it's open, it's open source. Everyone can join in the ecosystem of Zomma. So I'll touch on some of the infrastructure of how Zomma is built and how do we get our price. So right now, our DeFi pricing comes from Oracle, but then we will undergo this price with our calibration model, which that we will sort all these fragmented and inconsistent option price going through Heston model with generating a continuous price curve. So in that sense, with this price curve, we are able to fulfill, the 300 skills that you saw just now. We are able to fulfill and quote against to all these trades. So fulfilling all the trades that the traders put in. When the IV deviated too much, we will also include another model, which is WIN model, to kind of correct the IV and then quote the best option price for all our users on the platform. So like we mentioned right now, they are still lacking in the DeFi option space, where we try to offer as close to the traditional options products as possible. So we offer our traders that can buy and sell calls and puts freely and anytime, and we offer our LP the freedom to add and remove liquidity without much hesitation or restrictions. So you can keep this in mind. So these are some of the models that we use, which is Heston models that generates the comprehensive price curve, but we add in the parameter to adjust on the price quotation, which is the pool adjustment, and also the different percentage of the utilization of the fund. I will talk about this in my next few slides. And as you can see and imagine, how options requires and takes a lot of the calculations in order to be as precise and in order to be as ideal. So our team overcome many challenges in terms of calculating price and in terms of calculating Black-Scholes and Hestons. So that's why we come up with another idea of the on-chain price map, whereby we will include different parameters and IVs, and we update them as instant as possible to provide quotations to all our takers. So we will update the IV parameters such as sigma, gamma, and then we will calculate the price. And then when we upload on chain, there's a price map for our system to look up to and to map between the different price and different IV. And also, remember I mentioned we add in the idea of put adjustment as a parameter. So there's a utilization rate they will also add in when we try to moderate and we try to kind of adjust for our price. So price is adjusted from 0% to 10% when the utilization rate, which is the liquidity pools rate, fall within 0 to 95%. And price is adjusted from 95% to 100%, which is about only 5%, for utilization rate within 10 to 100%. So this is what Hesston model looks. That is a little complicated, but it's actually not. So Hesston model is a really stochastic volatility model widely used in quantitative finance to model the dynamics of financial markets. So I believe everyone is really familiar with how dynamics, volatility, and cryptocurrency is, right? So Hesston is introduced by this guy called Stephen Hesston in 1993 as an improvement over Black-Scholes model. I'm pretty sure you guys are familiar with BS model, Black-Scholes model, which assumes the constant volatility of the underlying asset, so which really aligns with crypto in comparison to the traditional finance products. So this Hesston model also assumes that the underlying assets follows a geometric Brownian motion, which is this part, the Brownian motion. So what does it mean is that it will undergo another square root process to generate the right volatility, to tell us the right information of volatility. So the parameter set of Hesston models, there are 5-dimensional subspace of this Euclidean space. So these are the, like the geek knows that these are the 5-dimensional subspace. So we basically use the Hesston model that described the dynamic of our underlying assets. So we offer Ether options right now. So you can imagine how dynamic it is for the market, right? So this is the idea of Hesston model. So what's more important is how do we get the option price? So of these underlying asset follows the Hesston model is that you can tell Hesston model actually provide a semi-closed formula in a sense. So what do we do first is that with the analogy with Black-Scholes formula, we try to guess the solution. So this can tell in our first equation where these P1 and P2 are basically normal densities in our Black-Scholes formula. So P1 and P2, we can't obtain these figures directly, but we try to use characteristic function of them. And then we use the inversion formula of the characteristic function to obtain the distribution of P1 and P2. So now we can actually just insert P1 and P2 back into our equation 1 to get the option price, right? So all this process seems really tedious. So imagine we're doing all these calculations on chain. These are so much challenge for us. But our team overcome these challenges as much as possible and to stay as decentralized as possible, that we overcome the problem and try to quote as close as to the reality. Right? With proper choice of the parameters, I mentioned just now, there are 5-dimensional subspace for Hesston models that this model appears to be very flexible and promising in the description of the option prices right now. And I will talk about the parameters right now, and because of time constraint, I will not talk about the initial variance and the long-run variance. I will touch on these two different parameters, which we also take into consideration. So the left actually shows the effect in changing the sigma. So sigma is the change in the volatility. So what is really important in options is that you get the volatility right, and so if we can observe the change in the volatility, which the vol, right, is actually provide us with a volatility curve smile that is as close to reality. And on the other hand, on the right-hand side, it shows the effect of changing the speed of mean reversion, which is understood at kappa in general. So we can see that as the change in for sigma, when we increase the sigma, you can see the curve, the volatility smile become more curvy. On the other hand, when we look at kappa, when we increase kappa in a sense from the blue to the green, 10 to 20, it becomes flatter in general. So the lower the kappa, the more curvy it is. So in this term, we see compensate effects of these two parameters to each other. So from these examples, we can tell this relation between parameters in terms of the smile and also relations between parameters. So what we're trying to do right here is that we're trying to find that powerful coefficient that allows us to generate and to map between the parameter space and the volatility space. So So we think model calibration is really, really important for protocols that go with the AMM kind of style, or protocols that use liquidity pools as their counterparties and counter makers in a sense. So during this calibration process, what we're trying to do is that the model try to get as close as possible to the observed reality. So most of the calibration problem can be formulated as an optimized problem. So in this case, we think this is one of our best innovation, because right now I think Zomma is the only one that use calibrated model in quoting option prices in comparison to some of the other players in the space. So with our calibrated model, we are able to get a more precise implied volatility, and then we will be able to use Black-Scholes model to quote a really competitive price for all our traders and LPs on our platform, and to be able to fulfill all the different skills, at the same time. While staking pool, liquidity pool, we also offer another innovation idea, which is pool as the products, where all these pools, each of it act as the fund by itself, where you can have your own equity, you can also have your own shares in a sense. I will touch on this just in a little bit. And also with different liquidity pools, it will be able to reduce trading slippage, and also we have more passive income for the LPs. Right, so in comparison to other DeFi options protocol, DeFi protocols in general, is that we offer multiple pool choices, whereby some of our competitors or players in DeFi options only offer one single unit pool. This really limits the choices of LP, and also it actually increases the risk that this platform has to bear. So for Zomma, we offer liquidity pools, when in turns we can offer different leverages and APR for all our users on the platform to choose upon. It also segregates risk. So it brings stability and it brings freedom to all our users. And these are some of the benefits of multiple pools. And what's more important is capital efficiency. We talk to many traders, be it retail or institutional. Capital efficiency is the most important consideration to everyone. So by looking at other players in our ecosystem, we try to be the platform that provide cross-margin trading and also the highest capital efficiency at the same time. So I think this is the greatest breakthrough for DeFi option space, and it is also another breakthrough for Zomma. So what are Zomma pools? Why is multiple LP pools so important? How do we offer different leverages and APR through our mechanism? So these are some of the ideas that you can take a look, is that we offer 4 different types of liquidity pools, ideally, from conservative to aggressive. So you can understand that the leverages is based on the correlation of the base leverages and the specific leverages that each pool is offering. So for instance, if Zomma pool, for example, conservative offers at n times of the leverages, right? So we use the calculation of the base leverages now at this 10 times. The equation goes like this. N over 10 minus 1 over N over 10. So this is how we calculate the leverages. So available liquidity that can be used for quotation is also calculated that way. So take this conservative pool, for instance, that there is 100% of the liquidity in this pool, right? So how do we manage and use this percentage of the liquidity quotation is, most of the liquidity in this pool is reserved, about 30%. And then 70% of the liquidity, the funds, are being used to quote against the traders. So as you can see, previously, we have 4 different pools: stable, balanced, and aggressive. So the reserve liquidity goes from 30% to 0%. So as aggressive it is, right, the liquidity reserve will be lesser. So in that sense, we are able to offer different risk-bearing level to all our LPs, and then the LP can also decide on what kind of liquidity pools you are more comfortable at adding in. So with the aggressive pool, please take note that we will require an initial margin of 10%, so to allow partial collateral with leverages to maximize the utilization of capital. So in Zomma, there's no fully collateral for any of our users. We require partial collateral at about 10% of the initial margin. So like I mentioned, another innovation is that liquidity addition and removal is freely can be fully done at all times. There's no restriction, no freezing period. So as long whenever you want to add in, whenever you want to remove, it's all at your ease and comfort. So these are some of the data that you will see when you log on to Zomma's trading page. So this is the liquidity pool page that you will be seeing. On the right-hand side is more like your account. So basically, you can tell like how much liquidity you have added in and how much unrealized PNL that you will get when during expiry, and also shares and cost per share. So these shares, thanks to GMS, you can understand the share as like a GLP, or we call it Zomma LP, right? So these are the shares, the ZLP that you will get, and the cost per ZLP. You can understand it that way. And on the left-hand side is the pool information. So when you log onto the liquidity pool, these are some of the data that you will be able to observe. For example, the equity. So what is the equity now for this pool? And utilization rate. Remember I talked about how our price is adjusted also based on our utilization rate. So that figure is pretty important. And the margin balance, available balance, and the price per share in this pool right now, and the total shares. So we also include health factor. If you are familiar with the traditional finance, you will understand that this can be a very important risk factors in the traditional finance, where it provides you the idea of how safe this pool is, and how safe your positions is, and how safe your trade is. So I won't touch on much of the formula right here, but these are some of the formulas that we use when we calculate our liquidity and also our equity. So please note, no trades will be involved when the available liquidity of one specific pool is less than 0. It means no money, right? So we can trade. So when the pool has no money, we won't be able to trade. I think that's simple as that. So liquidity removal, I think that's another crucial part, is that we allow funds to be added in and removed freely at any time. So the same, like on the right-hand side is what you will see when you try to remove your funds and transfer back to your MetaMask or any other wallets that you use to connect. So like I said, so the ZLP, the shares you got, for example, is about 980. If I remember correctly, is that I added 1,000 into this liquidity pool. So I try to just clear as freely as possible, like 50% of the amount that I want to withdraw. So I mentioned there's different price of the share. The ZLP price change. So right now at this moment when I want to withdraw liquidity, the price is at 1.01. So I'm gonna withdraw about 500 at a fee about 0.5. So the amount received after I do all this transaction on-chain approval, I will get about 497 of the USDC. So remember, everyone bears position. This is the pool position right now. Everyone bears position. So when I want to withdraw my fund, how about the position that come after me? So there are a few ideas that we do when we want to offset our positions. Bear in mind that we try to forego the maximum amount of the inefficient margin as possible when we are trying to offset this position to improve the liquidity of each pool and lower the overall risk of the pool. So when we try to do fund withdrawal, when we try to offset the positions, there are 3 orders that we do. Number 1 is we try to offset those sell position first, then the buying positions, and those out of the money, then to the in the money positions. So when they're out of the money, we go from the furthest strike prices and to the closest strike prices, and after we will look at the expiration date. Those are further at the expiration, we will clear them first and then slowly to far from the expiration. So liquidity removal work under normal circumstances, and fund will be withdrawn really successfully when the liquidity of each pool is sufficient. And in order to lower the frequency, yeah, definitely there will be some fees involved. So this is the difference, the comparison for the pool before I withdraw my fund. So this is how my account look like and how the pool information. You can see the slight differences in the change of the pool information. So remember, I withdraw about half of my liquidity in this pool, about 500 USDC. And you can see my shares kind of reduced by half, and my unrealized PNL, because I kind of do it right away, so it's kind of like a little ugly in a sense. And as you can see, right, the cost of share increased, the price of the share increased after, because when we remove funds, it will actually reduce the equity within that pool. So when other LP also goes, vice versa, where when LP add liquidity into the pool, it also dilute the share within that liquidity pool itself. So that is why we talk about a liquidity pool as a fund structure. With this idea of fund structure, the idea of equity, idea of ZLP, we are able to provide our LP a more flexible trading strategy and flexible trading experiences. So in general, for the trader right now, we offer cross-margin trading. So it's really simple. The trading experience is just like centralized options trading. It's cross-margin, and then we offer pretty much the lowest initial margin on most platform right now. And for the LP, you enjoy the flexibility to add and remove liquidity at any time, and this fund idea and structure with different multiple leverages for you to choose upon, and also a hedging purposes to safeguard your assets like an insurance. And these are some of our core team members. We are crypto OGs in Taipei. Tom and Taka has been in crypto space in 2013 and 2017. We founded another deck. So our team is pretty experienced, and with some of the innovations that we build, we believe that we are able to revolutionize options trading, especially on DeFi and also on zkSync. We just launched zkSync on the same day as Ethereum Hackathon Day 1. So if you are interested to know more about our product or platform, please go and try at app.pro, okay? I will show you guys the link later on. But honestly speaking, we want to learn more on zkSync at ETHTaipei as well, because we actually see some blockers when we develop on zk, but we believe it will overcome slowly. So I'll share with you some of the blockers that we have right now. Number one is the Oracle price feed. Like I said, price can be really important, right? But right now there's a lacking in an efficient price Oracle on zk, but they are really helping us really aggressively to overcome these challenges. And we try to talk to different teams like Pete and Redstone to look for the best solution. That is one problem. Another problem I think all of you would know would be the high gas involved, which every time when I myself try to trade on zk on our mainnet, we will experience the really high gas, right? The MetaMask will always estimate on like the amount of gas that require when you approve a transaction. So it actually costs 10 times more than what it actually is. So, but whenever we kind of click in the approve the transaction, is 10 times less. So we also try to know why, and if the estimation can be closer to reality, because without this high gas could really hesitate traders and builders. Imagine without an Oracle for products like options, for how non-linearity it is, it can be really costly right now for all builders, but we know and we understand it is still developing, so we try to grow at the same time. So I would like to invite all of you here today to try and trade on Zomma and provide us the feedback as possible. So if you try to trade on Zomma, you are also experiencing zkSync at the same time. So maybe you will enjoy some of the early incentive on Zomma and also on zk. Yeah, so this is how it is launched on the mainnet. So please follow our Twitter, Zomma Pro, after this event, and also start trading options, because it is a really important hedging tool that every one of us should know, because your key should always be your key. Thank you so much. You can talk to our member with the Zomma Protocol t-shirt if you have other questions or other inquiries that you want to know more about Zomma. Oh, thank you.
Thank you, Charlotte.